Thank you for joining our April property market update. I'm Michael Watson, Head of Distribution Asia Pacific with La Trobe Financial. Now in April, we're seeing moderation, not capitulation, with the housing market cooling after a long run of record-breaking growth. Sydney and Melbourne house prices were actually negative in March, and we're expecting that trend broadly to continue for some time. Nationally, we're expecting now to see housing relatively flat over the next 18 months or so, and in general, we think this is natural and healthy in the long run. But don't fall for the overhyped boom and bust narratives. What if I told you that 5-year house price growth was under 6% per annum? What if I told you that the increase in Australian house prices since 2019 is actually very measured by world standards? So, moderation, yes, even a fall of 10 to 15% in specific markets, depending on rate rises, but property fundamentals remain strong. And the balance of probability continues to point to plenty of opportunity for the Australian economy and for Australians. Now let's turn to a review of the sector. In an environment of historically low interest rates, the only way is up. So let's address head-on the key risk of increasing interest rates and the Australian borrower's capacity to pay. As noted within the Headwinds and Tailwinds review, Australian household balance sheets are in very strong positions to begin an upwards interest rate cycle. Household deposits, mortgage aheads, and overall household wealth are all at extremely strong positions as household assets have grown faster than household debt. At a top-down security position, the Reserve Bank's securitisation datasets indicates that only around 5% of loans have an outstanding loan-to-valuation ratio of greater than 75%. For comparison, around 25% of loans were greater than 75% LVR just 2 years ago. So we begin this part of the cycle with a sector demonstrating a strong security position. Securitisation data also suggests that the median excess payment buffer for owner-occupiers with a variable rate loan is equivalent to around 21 months worth of scheduled repayments as at February 2022. This is up from around 10 months worth at the start of the pandemic. So we begin this part of the cycle with a sector demonstrating capacity to absorb financial shocks. Finally, the percentage of households with variable rate home loans that have a high loan-to-income ratio and a repayment buffer of less than 1 month of minimum repayments has also fallen. So we begin this part of the cycle with a sector demonstrating fewer borrowers at risk to increases to repayments. Looking forward, and some scenario testing indicates Australian borrowers are very well positioned. Because of the elevated repayments borrowers are currently voluntarily making, even a 200 basis point increase to rates would see over 40% of borrowers require no change to their required repayments. A further 20% would increase their repayments by no more than 20%. Of course, an increase of 200 basis points is not in isolation, and we would anticipate some relief in the form of wage inflation to offset this. A common concern made is the possibility of a cliff event for fixed rate loans, as around 3/4 of currently outstanding fixed rate loans will expire by the end of 2023. These borrowers may be refinancing into a very different rate environment to the one they initially fixed at. Some 90% of fixed rate borrowers expiring in the next 2 years will face an increase in repayments. However, for over half, the increase will be at the low end of the range, in a range of 0 to 20%. Those expiring in 2022 will see a lower change than those expiring in 2023. And again, this is the scenario of a 200 basis point increase with no change to the borrower income position from the time they took the loan out, or from now until the loan position changes. The final point to make here is about business borrowers' ability to absorb shocks. A strong business sector will continue to employ staff, maintaining our impressively low unemployment numbers. Business have actively deleveraged, maintained surplus cash holdings, and have had little difficulty in servicing their debts. Most listed firms have adequate earnings to absorb a 200 basis point increase to business lending rates. Thank you for taking the time to watch our April investor call. If you have any queries, please do not hesitate to contact our asset management team on 1800 818 818. Thank you.